Okay, I think we're going to start. So good afternoon, everyone, and a very warm welcome to our session of the London Financial Regulation Seminar that takes place again today. We had some technical issues and we are repeating the session. The London Financial Regulation Seminar is an inter-collegiate and interdisciplinary group of experts in financial regulation, which is now led by myself, and the deputy is the presenter today, Dr. Daniele D'Alvia, and it was founded by Charles Goodhart at the London School of Economics, who was then the director at the time of this seminar, with the idea to bring together experts in financial regulation coming from law, from economics, from business, from finance, from accounting, even from political science, in order to discuss relevant issues to the regulation of financial markets in a broad sense, understood in a very broad sense. And it is a fitting topic today to discuss the latest book that Dr. Daniele D'Alvia has written, which is entitled The Speculator of Financial Markets. And the subtitle is How Financial Innovation and Supervision Made the Modern World. The book was published by Palgrave in 2023. Before I introduce the session, let me say a couple of words about Daniel himself and about our distinguished discussant. So Dr. Daniele D'Alvia, who is known to all of you, is a lecturer in banking and finance at our Center for Commercial Law Studies in Queen Mary University of London. And he's also an associate researcher at the European Banking Institute. We were actually having a conference of the European Banking Institute in Bologna this past week. Daniel has become an internationally recognized authority in the field of SPACs, special purpose acquisition companies, but he's also broadened his research and teaching interest into the areas of corporate finance, investment banking law, as well as financial regulation generally. And I am really delighted to have a close working relationship with him in our Institute of Banking and Finance, where he's also the deputy. A few words also about our very distinguished discussant. I will introduce again him briefly once that I give the word to him, following the presentation by Daniel of his book. Andrea Enria needs basically no introduction in circles of financial regulation and supervision. He's very renowned authority in the field. He started his career in the Bank of Italy, and he has the unique privilege of having served as chair of the European Banking Authority from 2011 to 2019, and chair of the ECB Supervisory Board, the single supervisory mechanism of the ECB, of which the governing body, the Supervisory Board, from 2019 to 2023. In 2024, he first joined the Prudential Regulation Authority as a senior advisor, and actually on January 28th of this year of 2025, the governor of the Bank of England, Andrew Bailey, appointed Andrea to the Prudential Regulation Committee of the Bank of England. That's again a very distinguished continuation of his career, and we can benefit in this country from his enormous experience and expertise. So having introduced the presenter and the discussant, let me say a few words, very few, because I don't want to take the time from Dr. Daniele D'Alvia to explain himself what this book is about. But the book that he has written illustrates very well a constant theme, a constant subject in the field of financial markets, and a constant theme, therefore, for supervisors and regulators, which is how to deal with the speculator, how to deal with the phenomenon of financial speculation, which is always rooted in some persons, a subjective person. Who are the speculators? Or those smart individuals, question mark, opportunist, question mark, or Do they just second guess the opinion of other investors to take advantage of market information and its fluctuations? And as it is explained in the abstract in which we made a summary of with the announcement for the seminar today, while many books have dealt with this boom and bust phenomenon, which is feature of financial markets, the fragility, the sentiment, the desires, the dreams that accompany financial markets. The approach by Dr. Daniele D'Alvia on the relationship between risk, uncertainty, and profit focuses on the difficult role that the law plays, and sometimes does not play, in regulating these subjects. And the book is also a reminder that the law has also its limits, and that therefore we must never be complacent in our assumption that we can simply regulate all the market dangers away. The book obviously draws on the famous book by Frank Knight, Risk, Uncertainty, from 1971. It's the randomness with knowable probabilities and uncertainty, the randomness with knowable probabilities. And in his historical cum legal, cum economic analysis, Dr. Daniele D'Alvia is going to cast some light on the modern interpretation of some aspects of this theory, and giving a new insight with this book, The Speculator of Financial Markets. So I will now mute myself. Let me just say a couple of housekeeping points. The session today is being recorded and will be made available later. And we will have, as we always have, first the presentation by Dr. Daniele D'Alvia for around 25 minutes. And then we will have the discussion by Andrea Enria for 10-15 minutes. And then we will have any questions that you may have, which you can either raise your hand or put them in the chat. I will moderate those questions, and we will finish promptly, as we always do, at 6 p.m. So Daniel, thank you very much for presenting the book. Andrea, thank you very much for being the discussant. And now the floor is yours, and I will mute myself and give the floor to Daniel, who will also be presenting his slides. Thank you also to our events team for having facilitated the people that are attending the seminar today, as well as the logistics of this event. Thank you.
Thanks. Thank you very much, Rosa, for this nice presentation. And thanks for having me at the London Financial Regulation Seminar. Today, I will speak about my last monograph, actually published in 2023, so not a long time ago. The monograph, for now, has already received some success. I presented this at the occasion opportunity in Edinburgh, London School of Economics, UCL, and other places. So it's my pleasure today to present this in front also, especially of my colleagues of Queen Mary University of London. The Speculator of Financial Markets is an idea that essentially was with me since I participated, maybe by chance, about the boom and bust of special purpose acquisition companies. Since then, I saw that the figure of the speculator in financial markets, it can matter. And this is why I immediately after that crash bubble in 2022, I wanted immediately, just in 1 year, I wrote this book, so came to me very easily. This is the table of content, and actually, as you can see from the title, the book is focused on one main figure, that is the speculator of financial markets. I analyzed the speculator and I critically analyzed his function in order to understand what is the role, if there was a role for financial innovations, and how supervision in reality played a role in shaping the world that we live today. The book is taking the stance that essentially both things are important and good, financial innovations, but also supervision. Without supervision, we cannot have the world that we are living in. And in front of new financial innovations, we need always to keep an eye. In the table of contents, you see that I had like a sort of maybe ambitious plan, especially in the first chapter, the old portrait, the new portrait of the speculator. So there I am analyzing also 2000 years of history, but those 2000 years of history are selected on only analyzing one figure, that is the speculator, and how this figure developed in time, since the old time of ancient Rome. The chapter in the middle, that is uncertainty, risk and uncertainty, this is quite important and probably the reading key of all the books, because essentially it's providing you with a reading key through which we understand that profit is connected to uncertainty, and risk is something that we can measure, but we cannot measure uncertainty, unfortunately. And that is also why supervisors, they find difficulty in anticipating uncertainty, but very good still today probably in measuring risk. And then, as Rosa was mentioning, the other books, they were taking this stance about analyzing market crash. And this is something that also I wanted to replicate in my monograph. So after I studied the speculator, I wanted to give a flavor about how market failures they play around with regulatory borders, without regulatory borders. So that is something that is an essential chapter to further analyze the figure of the speculator and the also legal provisions that they were made in order to prevent systemic effects that speculation can create. One point that I want to make clear is that there is not a legal definition of speculation. One side of speculation, that is short selling, it is regulated because in some way we have in Europe a regulation on short selling. In the UK, very recently, in 2025, they modified the law for short selling, and especially there are provisions to prohibit naked short selling when in reality the speculator does not hold the asset, the underlying asset. So we surely, have some legal limits into speculation, at least on the side of short selling, but there is also another side of speculation that is the bull market. So in reality, people that they buy an asset today to resell tomorrow in the future at a higher price. This type of speculation is quite, let's say, often we can see the speculation in cryptocurrencies, because they are not currencies, they are assets actually. And being assets, they fluctuate in the market in terms of value. And so speculation in terms of bull market can propagate, and it's difficult to stop, but can cause, of course, systemic effects to market operators and to markets in particular. So short selling is analyzed also in this book, in this monograph. Let's have a look at the taste of the book. So let's start from ancient Rome. Actually, in ancient Rome, for example, there are no specific sources, but they said that one name for the speculator was Greci. That means Greeks. So there is this kind of anecdote that we think that maybe Greeks, they are going to speculate, or at least ancient Romans, they were thinking that. But then Plautus, that was the playwright of that time, is giving us an image that is different about Romans. Essentially, Romans, they were those speculating. And in fact, he also identified a specific point in the Forum Romanum, so the Roman market, where in reality behind the Temple of Castor, you can find those who you may lend at your cost. Those are the speculators, so they are seen as impudent, told captive. In reality, they are not seen in a positive way or within a positive light, because actually they always exploit the market. That is the idea behind. And this idea, we can see in history quite often. For example, here in London, I born in Rome, but then London became my second home. It's more than 14 years that I am in London, and there I saw that essentially, one of the main stock exchange in the world, then the London Stock Exchange, before there was a formation that was quite informal, through coffee houses. Why? Because at the time, Puritans and Protestants, they believed actually that the more you work and the more you are close to God. So even in that fashion, a speculator is not close to God. It's someone that in reality is manipulating the market or maybe taking advantage of information in order to exploit the market and obtain maybe huge profits. And not through hard work. This is why they were meeting at coffee houses. And in coffee houses, they were trading in reality shares. But still, the stock jobbers in a bank in London at that time, they were seen playing or expert in a iniquitous art of stock jobbing. So in reality, I mean, there was not equality or was not seen as something that was positive for the common good. While, for example, a company or corporate law, we might say that a corporation can serve the purpose that is a purpose of the common good. The speculation has not seen ever in this way. And I mean, in the book also, you can find much more even about witch trials. I mean, if you were in medieval times and you were someone that maybe could make some money and more profit than others, you could even be seen as a wizard, as a witch. And those are all things documented in reality, I mean, in historical documents. But speculation is also important today, very important today. For example, from Reuters, we have a news from January, so just last month. There are hedge funds that are the speculators of today that essentially they are piling up short positions against the British pound. Or in the past, a little bit more past, in 2014, if we remember about Monte dei Paschi di Siena, still the oldest bank in the world. Essentially, there were problems there. It was going probably to collapse. And essentially, in order to fix that bank, the CONSOB, that is the financial regulator in Italy, imposed a ban for some weeks, days for short selling in order to not manipulate in reality this value of the shares that they were listed on the market. And more recently, like always in January, we have seen this new financial innovation in AI-driven investments, DeepSeek, a startup founded by hedge funds that essentially has a new model, a model that is disrupted much more probably than NVIDIA, that is the competitor in the US. But this has, in reality, I mean, triggered a systemic effect in the Magnificent Seven, so Apple, Google, and so on. And that is something that has drawn the attention of investors from NVIDIA to new forms of financial innovation in AI. At the same time, in the Chinese market also, this has created a bull market. So in reality, everyone now is investing in the next big thing. So in reality, many times speculators, they don't invest in a company that is delivering a product or that we know that the product is safe. They invest just in order to sponsor the ideas, the dreams of people, of businessmen. And that is how, in reality, speculation is driving financial innovations. So the force of speculation is in this kind of aptitude that sometimes is not really to manipulate the market, but sometimes is to found or to sponsor new companies that they can become new market players and be dominant in that sector. We saw this also, for example, in the dot-com bubble. There were many internet companies. Not every company was good, of course, but then after the crash, companies like Amazon, Google, they emerged. So financial innovation is there. So speculation is something that is positive because it's giving the possibility to business people to provide to the world a new development. For this, in reality, financial innovations made the modern world. If you start, in reality, I mean, to follow the arguments. I spoke about Protestants. I can speak also about Christians. I am Christian myself, and essentially, I mean, also St. Augustine reminded us that speculation, or in reality, this seeking of profit, unlimited lust for gain, is something negative, is a sin, a capital sin. And so Christian culture was always against financial speculation. You need to, for example, lend money, not to take advantage of the other. For example, I was involved very recently in a Viva PhD, and I was, as a Christian, speaking with Muslim scholars, among them Professor Rosa M, that is an authority in Islamic finance, and we spoke the same language in some way. We started to understand what is investment, what is speculation, what is gambling that can be masir, in Arabic, that means something that is forbidden completely under the Quran, the holy book of the Quran. So the same problems are in the West, the same problems are in Islamic finance, the same problems are in Christianity, the same problems are in the Protestant culture. So it's not something that is different. But still here, for example, Knights Templar, that they received in time many donations from Christians, they became very important in Christianity, they were defending Christianity. They invented also the letter of credit. So in reality, here in Temple Church, that is a church in London, in Fleet Street, you can actually see that this is the first bank in the world, actually. So in the medieval time, there were pilgrims depositing money in Fleet Street, and then there was another branch in Jerusalem while they were going for pilgrimage. So they didn't have to carry many valuables. And so for this reason, they could not be attacked, and then they could just withdraw the money. This is like the equivalent maybe of electronic payments of today, of the medieval times. So as you can see, financial innovations, they can provide an hope to people. They can give something that is beneficial. But probably it's how we use financial innovations that should worry us, because even there, I mean, Knights Templar, they started to lend a lot of money to Prince Philip, and this in reality then, as you know, created the problem to Prince Philip in France that also ordered the dismantle of the order. But the book is also interesting because it shows that from Vatican archives, I've seen with other people that they wrote also books in this regard, that the Pope of that time actually did an apology, and also in reality, I mean, didn't condemn Knights Templar. So something that was very recently discovered, for example. So sometimes also the interpretation of history can be manipulated. And in terms of manipulation, I can go over them later. Banking is not only about money, especially as Oscar Wilde, another of my favorite authors, said that in reality, bankers, once they meet for dinner, they discuss art. Art is important. It is an alternative asset class. Still today, we might even find hedge funds that they are specialized in investing and speculating in art, for example. But this idea of art, this connection with art, is from Medici time, House of Medici. They invented also a new form of speculation, because at the time, interest, you could not charge interest. Still today, for example, in Islamic finance, you cannot, because it's an haram, and riba is the equivalent in the Islamic world that means prohibition of interest, in fact. But for us, now it's possible. At that time, it was not possible, but the Medici, they had this invention of the bill of exchange, and to profit from the different foreign exchange rates. Here you can see how, in reality, in speculation, information is very important. And here, for example, is an old map of bank. In the middle, if you see Trinidad Street, there is still the Bank of England, then there is Lombard Street, and then in front of the Royal Exchange, there is Exchange Alley. That is where, in reality, speculators, stock jobbers that I was mentioning before were there. But why they were there? Because essentially, in Lombard Street, there was the post office, and all the information they needed to necessarily come inside the forced inside the square, and that is where the speculators they were there in order to grasp information before others and then to speculate on them. The same ideas of informality, how a stock exchange born from informality to formality to a physical exchange, it is also in New York. So at the time, the car market in New York, for example, was on the street. Also, that is the same of the 17th century in London. But here, for example, a journalist is giving us the same, maybe, definition of speculators of Plato, where he said that you could borrow $1 million on their moral credit, but for others, the jail becomes. So again, the idea or image of speculators is not good. But still, even here in the card market, non-regulated market, a financial innovation in some way, because I mean, just born on the street. If you can see from the slide, the very important companies that we recognize today, they started there. and then from the street they went to the New York Stock Exchange. It was a formal place with more regulation, and still this kind of practice sometimes is still done. I mean, multilateral exchange venues, so facilities. In that case, for example, that there are less requirements on the market, companies, they try maybe at the start to list there, and then they go and they list again in more formal exchanges. So a practice that born and continued since that time. In terms of speculation and how we can in reality take advantage of information, I mean, this is quite famous, the event of the Battle of Waterloo. Even there was Nathan Rothschild, one of the first of the family to in reality made, they say, the family so rich. And he did this through speculation in the gilts market at the time. For example, that is an insider dealing, but also insider dealing didn't exist, for example, at the time. So even all the interpretation that was given, for example, by Nazism subsequently, or by other people in Europe at that moment, but in reality Nathan had a courier that was private. He paid privately that courier, and he could obtain that information of the outcome of the Battle of Waterloo before others. But still, before Nathan could do this, that was legal at the time. Before this, there was also another event, always in London, in that market, where there were people claiming that in reality Napoleon won the war, and that was a market manipulation, very famous on the exchange alley. And this is something that also, I mean, so even very important members of the parliament that at that time they went to jail because they tried to do market manipulation. Then Trump trades. Even there was speculation, there was especially short selling. Many hedge funds, they piled up short selling positions against companies operating in green economy. Because of course, Trump, I mean, is not pro this sector, even Paris Agreement is not in favor and so on. And so before his election, they piled up the short selling positions, betting against the value of those companies, and they won immense amount of money. But then Trump also did other things. I mean, since his election, there was a very exponential growth in the value of Bitcoin, in other assets, in hedge funds, in Wall Street in general. And so this is also to show how political events can affect markets, how news, in reality, rumors of the market can have an effect on the value of the assets. But even there, if we think about, I don't know, speculator, it means speculum in Latin. So in reality, it's always a self-reflection. It's in reality a subjective idea that an individual has in relation to the future. And that is the difficult part of speculating, because no one is guaranteeing you the money in some way, even in that bet of short selling, for example. Maybe Trump didn't win the election, and so that positions, it means that you have lost exponentially a lot of money. As also Newton said, I can calculate the motion of Evelyn bodies, but not the madness of people. So this means that in reality, how we can stop those people from speculating. Even him, he was a speculator himself in the South Sea bubble, for example. He lost the equivalent today of £3 million, for example. And here is when I was involved by chance, I mean, in my life on special purpose acquisition companies that also the Financial Times said they are the same equivalent of casual companies of the South Sea bubble. In reality, yes, with some differences in my view, because in my view, a SPAC is more similar to the VOC, that is the first company, I mean, public company in the world in the 17th century in the Republic, in the Dutch Republic at the time. And I wrote also a paper, if you're interested about that, where I explain a little bit the differences. But even here, a casual company, in any case, is a company that doesn't have a balance sheet, and there are only managers and their ability to convince investors in order to invest, and then to make an acquisition in the future that we don't know what they are going to acquire. So that is possibly the maximum extreme or symbol of speculation, if you want. Speculation has always existed, but also financial scams, like Gregor MacGregor, that was a Scottish man that was claiming that there was an imaginary land, Foyer, and essentially didn't exist, but he was thinking and saying to investors that he was the king of Foyer, and so he issued bonds. At the time, many they bought the bonds, and then in reality, there was the investment, was not profitable, of course, because it didn't exist that land. The same, a little bit different, happened in any case, whether FTX, the crypto exchange of in the US, was the scam of the century. So those kind of concerns, as you can see, are from the past, are also in the present. I see that I almost reached the time, so I would like to, we are almost at the end, but I would like to put some final, let's say, considerations. AI, it is a new financial innovation, but for example, I was thinking the printing press. At that time, everyone was worried about how we can use this level machine, or for example, even then the radio and so on. And now it's AI. So the human beings will always be concerned on these new financial innovations. But at the same time, without those new financial innovations, those innovations, if you want, we could not have the world that we have today. So all those times were in reality triggered by financial innovations and speculation. How then that financial innovation are used is another point that sometimes can also lead to systemic crisis. This is why I claim in the book supervision is needed, is necessary, and is important. Bitcoin also, for example, I agree with the position of the president of the European Central Bank that says that we cannot adopt Bitcoin as a reserve in central banks. But for example, even in game theory, who is going maybe to take the first step is going to have an advantage. And if I'm not wrong, is the governor of the Central Bank of Croatia. He wants to invest and have reserves in Bitcoin. The same now Trump is thinking about a reserve of Bitcoin that can even be something completely different and even in reality more important. But at the end of the day, Bitcoin, I agree that is not, in my view at least, a currency. It doesn't perform the function of money, doesn't have these essential functions of today, and is an asset, a speculative asset, where in reality this value is fluctuating so much, sometimes to the start, sometimes to the bottom, and we need, with supervision for sure, to make sure that especially small investors, retail investors, they don't get damaged. Because sometimes qualified investors, they also have enough money to cover their losses, but not families. What about even stable coins? If we adopt this at the retail level, they think that is a very big, huge financial innovation. Could be. The point is how we use it and how we allow people to use it. And the same thing in electronic payments. So let me conclude on risk and uncertainty. All those stories in the books that you can read, if you buy the book, they are all triggered by risk and uncertainty. So risk in reality is a measurable entity. This was said by Frank Knight, but also by Keynes. And then uncertainty, something that is mysterious, that we don't know. In reality, also Keynes wrote about uncertainty. Many people that criticize him in his last book, The Theory of Employment and Capital, and they ask him, in reality, what is uncertainty for you? And actually, he answered in a way very simple. Uncertainty is what we know that we don't know. So I don't know if the next war is going to end, if the next war is going to start. And that is why uncertainty is there always in human beings, and also is causing anxiety to us. So we have every time governments that they want maybe to issue new rules, new regulations, because they want to govern, to try to anticipate uncertainty. So this is also the feature that I claim that is a little bit a paradox of modern economies, because we blame uncertainty for its mysterious character, for the fact that we cannot define it, we cannot measure it, we cannot regulate it. But at the same time, we know the more we reduce uncertainty, the more we reduce profit, because profit, as Keynes and yes, also Knight was always saying, is connected to uncertainty. So it's the ability of the businessman, or if you want, the speculator, to speculate into the next big thing, as that vision that no one else has. Sometimes it's good, sometimes can be bad. We need to be sure in reality that we are there to avoid manipulation of the market and other conduct like insider dealings that of course are negative. In fact, I don't claim against those statements. So let me conclude with William Shakespeare, another favorite writer of mine that said, "We are such stuff as dreams are made on, and our little life is stranded with a sleep." So essentially, our life has been small, is small, does not last long, this journey. We have made a lot of progress in 2000 years, but we are also able to destroy things in a global scale, like the global financial crisis, if we believe or we think about it, had many consequences where the higher executives never paid the price, but the poor people, people that they took those mortgages, for example, they end up in the street. So I think that human beings, they can be great, but they need to use, first of all, probably the art before thinking and speaking. Thank you very much.
Thank you very much, Daniel, for this wonderful presentation of your book. And without further ado, I will give the floor to Andrea Enria. For those that join a bit later, Andrea has just been appointed by the Governor of the Bank of England to join the Prudential Regulation Committee, following on his extensive experience both in the European Banking Authority as well as in the European Central Bank Single Supervisory Mechanism. Andrea has also been a friend and esteemed colleague for many years, and I'm really delighted that he made the time today again to discuss Daniel's very interesting book and presentation. So Andrea, I will mute myself and the floor is yours.
Thank you very much, Rosa. Thank you for inviting me, and thank you to Daniele also for having me as a discussant for his extremely interesting and thought-provoking book. I have to start by praising this erudite historical reconstruction of the concepts of risk and uncertainty, and I think that discussing apparently, far in time issues such as the birth of probability theory or the first approaches to risk measurement and the treatment of the most elusive concept of uncertainty is something which is also very relevant, as Daniele also said towards the end of the presentation, for the issues we are grappling with right now, for the policy debates, for the theoretical debates which are taking place right now. Besides everything, it is a joy to read, as we have seen also from the presentation. There are quotes from the Bible, Renaissance paintings, lines from Galileo, connections between existentialist philosophers and the role of anxiety in making choices in an uncertain world. So it's really interesting and provides a deep underpinning of the questions that we grapple with when we consider our attitudes towards risk, innovation, and speculation, and therefore the behavior of financial markets. Now, my understanding of the characterization of the speculator by Daniele is as somebody who, yes, to some extent has a better reputation, but has also a very positive connotation, something similar to Schumpeter's innovator, as Schumpeter's innovator was breaking the circular flow production to introducing new opportunities by introducing new products, new productive processes, or improving existing ones. The speculator of Daniele goes beyond the ordinary calculations of probabilities and risk, the passive approach towards uncertainty, in which everybody tries to guess the other's action and place himself basically around the average outcome, the market index, we might say. speculator is somebody who takes uncertainty heads on and searches for extraordinary opportunities for profit, and therefore shifts the average behavior rather than accommodating to it. And it can therefore become also an extraordinary engine for disruption and growth. As a consequence, Daniele raises also important questions as to the appropriate attitude of regulatory and supervisory policy. Regulators, after all, are, as others, prisoners of their own time in terms of the attitudes towards risk and uncertainty. So interestingly, Daniele shows how the recent developments can be seen also as a pendulum swing, in terms of the attitude. So from a moment probably predominant in the early 2000s, in which financial firms had a lot of confidence in their ability to measure and manage risk, and supervisors, regulators, to a large extent, rubber-stamped this attitude and praised the extraordinary advances in risk management, in modeling of risk, and started also, as most of you know, to include internal models of financial institutions into the calibration of actually regulatory requirements. And this was done, we have to say, against the cautionary messages raised by a prominent economist, and Charles Woodard and his team as the London School of Economics were very, very much raising red flags when these developments were taking place. But then the crisis, the great financial crisis came, and it was clear that a new attitude was started prevailing, in which after realizing that uncertainty, basically materialization of uncertainty, wiped out all the confidence in the ability of firms to manage and precisely measure risks, a much more cautious approach was instilled by regulation. And so basically, as I think Daniele is very, very politely indicating, there was a little bit of hubris also on the side of regulators in their basically attempt and maybe pretense to be able to control uncertainty and to reduce everything that might occur in the financial space to predictable let's say outcomes, and that this attitude might have been curbing also the attitude towards innovation. And this is where where we are right now, with maybe a consideration that the pendulum swing too much in the direction of regulatory suppression of the activity of the speculator and potentially the ability to drive innovation and change. Now, I have three main comments to make on this point, all relatively open-ended, I would say. One bit less so, maybe. My first point is on, let's say, on success on terminology. So the speculator, when we talk about the speculator, also across the very, very interesting examples that Daniele makes, we have in mind different types of behavior. So we could have speculators operating for very short-term profits, taking highly leveraged bets, sometimes trying to move prices and market perceptions with actions that might be also, as Daniele said, borderline or even beyond what is acceptable, and going to the field of market manipulation. I have a very fresh memory of what happened in 2023, when after the demise of Credit Suisse and the crisis of regional banks in the US, there were if there were a lot of speculative investors that started looking for weak links in the financial institutions and then taking high bets in terms of short positions on stocks. At the same time, sometimes, admittedly, there was no smoking gun, taking also heavy positions on CDS market, on credit default spreads, that therefore triggered changes in stock prices, and also triggered changes in the decisions of uninsured depositors to withdraw funds, which started spiraling and generating huge profits for the speculators, but also, a lot of risk of market disruption. Sometimes behaviors which are difficult to contain and contrast when they are taken across jurisdictions. So when you have international investors that take different positions in different marketplaces and therefore escape the possible interventions of market authorities. So it's clear that these type of behaviors need to be kept under check, that you need to distinguish those behaviors which are short-term but still driving market efficiency, efficient pricing, those behavior which drive more long-term growth and innovation, and those behavior instead which can create disruption of value and destruction of value and potentially also financial crisis. And that's what regulation should do. One could argue whether regulation has become too complex, too heavy-handed, and again, it's a big question. As market practices become more complex, sometimes regulation has to follow, but maybe there is a fair assessment that the approaches went too far. My second point is more, let's say, maybe more to the core of the issue raised by Daniele, which is also a comparison of different attitudes that there could be in the regulatory framework towards experimentation of new financial practices in the financial sector. And here I think that there is a fundamental difference between for instance, the approach which is followed in the US and the approach which is followed in the European Union. In the US, I remember Alan Greenspan, for instance, being very clear that you need to leave space to non-regulated institutions to experiment with new practices in an unregulated space. So you need to avoid intervening too much on non-regulated entities, and try to let them also sometimes enter into the field of regulated institutions. At the European Union, there is a more constraining attitude in which everything that is new generally tends to be regulated immediately. The Artificial Intelligence Act is moving, for instance, in this direction. The UK, to some extent, is in the middle. No, they have experimented. We have experimented in this country with sandboxes and attempts to, create spaces in between, between the regulated and non-regulated world, and to favor a transition from one to the other. I'm deeply, imbued by the European attitude. I think that Greenspan's approach has led to very light approaches, for instance, for investment banks in the lead up to the great financial crisis. Entities like AIG were not supervised at all in creating systemic risk. But I have to admit that that is a system that has been able to channel much larger amounts of funding towards innovative digital and let's say investments than has been possible in other areas of the world, and this has led much more growth and profitability in that framework. So I think it is a legitimate argument to discuss whether we want to go a little bit more into that direction. I would argue that this is not about banks. I don't think it's deposit-taking institutions the task of financing that type of investments, but again, I think it's a legitimate debate to have. Last point is the issue of leverage. We are now in a situation in which we have the highest level of leverage in history at the global level, with different combination of households, corporates, or public sector. This has been documented by Claudio Borio and his team at the BIS, for instance. So the point is, if we want to intervene, to favor a greater support to investments, long-term investments in digital, in climate technologies, I think we should be very careful on the balance between equity financing and debt financing. And I think especially that, as I also mentioned, that maybe, watering down the standards for banks is not a very good idea in that respect. So watering down, for instance, the Basel framework to support growth in that respect would be a mistake. This is not being done, I think, at the EU level. This is not being done in the UK level. There are some deviations from the US, from the Basel standards, but I think remain in a relatively reasonable space. It's important that the US also follow through in the same direction. I will stop here. Thank you very much.
Thank you very much, Andrea, for those very pertinent comments touching upon a number of issues that really remind us that the subject that Daniel has dealt with in his excellent book touches upon many of the challenges that regulators have on a daily basis, how to manage actually the phenomenon of innovation, how to manage regulatory boundaries, how to manage shadow markets, how to deal with the cross-jurisdictional challenges that you were talking about, that also creates opportunities for regulatory arbitrage and sometimes for speculators to actually exploit the loopholes, often the legal loopholes. And so I will ask now if there are any questions from the audience. But before doing so, I would like to give the floor to Daniel to have the opportunity to respond to the really very thought-provoking and insightful comments, as well as the very positive feedback that he has given on your book. So, Daniel, before I open the floor, just in a couple of minutes, if you would like to respond to some of the excellent comments and to some extent questions that Andrea has posed to you.
Absolutely. Thank you very much. Thanks, Andrea Enria, for your insightful comment. And I think also from what I saw today, for example, there is a lot of discussion about regulation by competition. And also the fact that, for example, if we think about the UK and the new Financial Act that has been given, a new mandate to the Financial Conduct Authority in terms of growth for competition. I think we live in a world that is very also fragmented, no more a lot towards globalization. And so we have this phenomenon that probably is even made even more evident with Trump policies, where in reality, if you are not competitive, you are out of the market. If you don't have the ability in your London Stock Exchange, for example, to attract, lure the attention of investors, everyone will prefer a dual class share model of Hong Kong or New York. But I agree with you on the fact that this does not mean that we should lower our level in reality of standards. So the standards in reality are important to be kept. Otherwise, there might be behaviors that are taking advantage of the system. So we need always to measure and balance those two objectives, that is to sustain financial innovations and not to kill financial innovations with over-regulation, but also to keep a balance in supervising the system and avoiding behaviors that are out of place in the market and they cannot be justified in any manner. So in this, the European Union has been a very good actor and example in this international area. I think you are muted, Rafa.
I'm muted. We have a question from Bill Blair, so I'll give the floor to Bill, just a quick one. Bill?
Yes, well, first of all, congratulations on a really interesting book and a great presentation. Daniele. It's very, very interesting. And thank you also to Andrea. It's great to have you at the PRC. Can I just a very quick question, but it's one that happened to arise in a case involving Sri Lankan futures, and the question was whether the transactions had been entered into as investments or speculation, and liability turned on that particular issue. And I was just wondering if you, Daniele, if you agreed with the way that Andrea put it, which was that, well, the differences between acceptable investment behavior, I think, was what he said, and creating destruction of value and potential financial instability.
Thank you.
That's a very good question. And yeah, if you take that, then one more question in the chat.
I mean, I completely agree in the sense that I believe that there should be, first of all, a difference between investment, speculation, and gambling, as I said also during the presentation. So everything that maybe is towards taking advantage of others or manipulating the markets, or in reality, even manipulating the assets price in order to profit and take advantage, that is more gambling. That is something that should be avoided or should be regulated as even financial crimes sometimes. On the other hand, speculation is in between, so it's something that is difficult to define, but we can create borders in order to, in reality, identify always more what is a speculation and what is something that is good for the system and what is something that in reality is only creating disruption of value and systemic risk. Especially that is another concern to avoid, of course.
It is interesting, the question that Bill asked us, as well as your answer, reminded me that in the many reflections that we had following the global financial crisis, the report by Lord Turner, who had obviously been at the helm of the Financial Services Authority, he said that many of the activities in which some of the financial institutions had engaged, they were socially useless. And that, I remember, it stuck with me. Obviously, what you're talking is different in terms of speculation, but sometimes I think the point that also Andrea was making with his excellent comment, to which Bill also refers, is what is sometimes the difference, the boundary, between this, what is good investments, what is innovation, which by definition they will be risky, and some of them very risky. I mean, there is, and that's actually good, because that's actually how the financial system continues to flourish, by taking risk and understanding your risk and then measuring, calculating, and pricing those risks. But what it is the limit between what is acceptable and not acceptable? And this phrase that Lord Turner expressed, in a bit of almost anguish of disappointment, given how much damage the crisis did in terms of the confidence in the system, but also then it proved to be that sometimes the accountability, the personal accountability, was not enough, and it has led to a number of reforms, including the senior managers and certification regime. But just to finish, there is a question in the chat which is very much related to the same line that Sir William Blair and Andrea Enria mentioned, is by John Taylor, and he writes, should crypto asset issuance be regulated as gambling?
Yeah, essentially, I mean, I think it's like casino capitalism. So in reality, cryptocurrencies is like exchanging money for fishes. So you go to the casino, then you play, and then once you get your return, you go out and you cash out the money. It is pure gambling, essentially, speculating in crypto assets. So yes, I agree that potentially if we just put in place the gambling laws, that is enough to protect, in reality, I mean, speculating behaviors in some way. Because, of course, I mean, I don't agree that crypto assets are currencies. So I think more that they are assets for speculation, made for speculation. And then we can use other kind of mechanism. For example, in stable coins, if we think about token depositors of tokens, there maybe I would extend the regulatory border of banking regulation in terms of deposit insurance. So, and here lies in reality the difficulty, because what I spoke in relation to in this book for 2000 years is traditional finance. And now there is the emergence of the centralized finance. And so also the question is for regulators and supervisors, do we want to extend these borders and to give indirectly a sort of role to those actors that essentially once, for example, extend a regulation in terms of deposit insurance, you cannot negate that person to go to the central bank in case for a lender of last resort, because there are obligations and rights. So in reality, as obligation and rights are imposed to bankers, if we extend those to non-bankers, non-bank financial intermediaries, shadow banking, at the same time, they can claim that right. And I don't know if in reality is good for humanity in some way.
Andrea has raised his hand to make a comment. Andrea.
Well, it says, I mean, I fully agree with Daniele in many respects. I mean, the only question that from a regulatory point of view, I think is very open and difficult to answer is how much an extremely restrictive regulatory approach to the crypto war more generally could prevent the development of technologies that many responsible people in the financial industry consider potentially positive. No, for instance, the development of smart contracts, no, which are linked to, which are enable, let's say, the execution of contracts on a verifiable basis based on blockchain or other type. So it's a difficult balancing act that we should navigate here. I think all in all, both the UK and the EU followed a relatively balanced approach here, not really closing totally the door, but putting some constraints that try to put outside the boundaries only the most unacceptable and speculative approaches, taking retail consumers a little bit out of the remit of these products, and try to enable some use of the new technologies in this space, which I think is a desirable objective.
Thank you very much. And I think on that sensible note of in a way balancing, the book is balancing, innovation with speculation, innovation with supervision. And clearly in the digital world, there are many good opportunities, there are many risks that are worth taking. And there are also innovations which, can contribute to the welfare, coming back to the socially useless. There are actually some innovations that will be quite socially useful, not useless. And it's just, for the challenge for the regulators is, where to draw the line, it's always the boundaries, where do you draw the line? And also in a competitive world, and Andrea was mentioning the issue of, in a way, indirectly regulatory arbitrage when we talk about cross-jurisdiction, we need to be aware of the divergence in legislative developments and regulatory approaches. And clearly one of the things that we will have to see, but it appears that under the Trump presidency, there will be a more favorable approach to the liberalization, I don't know if regulation or deregulation of some of these aspects. And so we live in a world in which global competition remains important, notwithstanding the forces of deglobalization. So it will be interesting to see in practice, in a way, the big themes of your book, which is speculation, innovation, risk, uncertainty. And then from the perspective, like Andrea now sitting at the PRC, to what extent and in what manner should we actually regulate and supervise, and to what extent and in what manner should we leave the market to continue to flourish within boundaries, obviously the boundaries which are given by the goals of financial regulation, financial stability, market integrity, consumer protection, prevention and protection of the use of the financial system for illicit purposes. All those things remain valid, but it is an interesting game. That's why no student in our field, and I can see that in the list of people attending today, can ever be bored when one studies this subject, because though they've been historically going, as you very well proved in your book, the innovations, precisely because they're innovations, they're always novel, and they always bring a challenge for us to think on how best to approach them. So with that final thought, thanking very much Daniel, thanking very much Andrea, thanking very much all the participants, and in particular Bill and John for having asked questions, and all the others that can continue to debate with Daniel in our classes and in our seminar. Let me wish you all a good evening, and thank you very much for what was really a terrific session. Thank you so much. Bye-bye.
Thank you very much. Bye-bye.